Imagine investing in one of the India's best companies. 5 years later, the company has grown, profits have increased, business is stronger than ever, but your investment has barely made any money. Sounds impossible? Well, that is exactly what happened to nearly one in every four Nifty 50 stocks. A recent analysis shows that around 25% of Nifty 50 companies delivered flat or even negative returns over the last 5 years. Names like TCS, Infosys, HDFC Bank, Kotak Bank, Reliance, Hindustan Unilever, and Asian Paints were among them. So, were these bad businesses? No, not at all. Most of them continued to grow revenues and profits. The real problem was something most investors ignore: valuation. Remember this formula? Stock price equals to EPS multiplied by PE. EPS is controlled by the company, PE is controlled by the market. Suppose a company earned 20 rupees per share and traded at 50 times earnings. 5 years later, earnings doubled at 40 rupees, but investors were no longer willing to pay 50 times earnings. Instead, they paid only 25 times. The stock price hardly moved, even though the business became much stronger. This is called multiple compression. So, the lesson isn't that blue chip companies are bad investments. The lesson is this: a great company bought at the wrong price can still deliver poor returns. Professional investors don't just ask, is this a good company? They also ask, am I paying the right price? Because in investing, the businesses create earnings, but the market decides the valuation. If you like this video, subscribe, share, and comment. Free equity analysis course link in the description. Thank you.